This month marks the start of summer trading. Our chief equity strategist and economist, John Blank, and his stock strategy team here at Zacks has pulled together the major large cap U.S. stocks facing 2025 tariff headwinds. John's here now to discuss this. John, looks like these fall into two major areas as far as imports and exports are concerned. What are they?
Yeah, I mean, basically, we've got a number of stocks that get delivering a lot of exports outside the United States. I mean, the best one is to think of is Apple Computer, which has got a huge base of consumers outside the United States. So they would be affected by any pull down in U.S. exports, which would be tit for tat and retaliation by other countries. And there's imports, which are largely our major retailers. Home Depot would be one, Dell would be another, who are importing things to sell in the United States. Those will be affected by our tariffs on our imports of these types of goods, not services. So that is basically the difference here.
So, generally speaking, what are the top sectors going from, let's say, very attractive to unattractive that are going to face these headwinds?
Yeah, the major one is the major retailers, which is consumer discretionary, which is why that sector has been held down this year. And the other one is infotech, which has long global supply chains.
So, as far as headwinds are concerned, are we just talking about large drops in these large cap stocks, or are there other things at play?
No, actually, Terry, we're talking about basically sideways motion for the large cap stocks. And I got the S&P 500 today. We're talking June the 18th, up 2.25% on the 6 months of the year. So it's basically, it's very soft sideways motion after that big pullback in March and April for the large cap stocks. But what is still down is the Russell 2000, because these are smaller and middle-sized companies are the ones that often bring in tariffed goods, and that has a much greater impact on them than it does the bigger companies.
Does this situation surprise you at all?
No, it doesn't. I mean, I think, again, people are always, speculating on how the second half of next year will go. Since we have half a year in play already with this administration, we already kind of can speculate that, extrapolation of sideways and soft upward motion in large caps, downward and, soft downward motion in small caps, and, basically long pull back and caution more than anything is going to continue.
You've written that there's a sense of relief now about the effects of U.S. tariffs on the top stocks of the U.S. biggest importers and exporters, but that it may also be temporary share price relief. So, given recent tariff developments, are we looking at a temporary situation?
Impossible to know, Terry. We've got 90-day pauses put on a lot of the tariffing, and talk of with good faith bargaining that they will be extended. But those types of wording are subject to what the Treasury Secretary and the President ultimately decide. So it's a never ending battle to figure out whether there's going to be changes. And by the way, the thing I have learned that we all have to understand is upside and downside surprises are equal. Saying something's uncertain doesn't mean they're just downside. There's upside and downside.
Seems to me that so far the market has had a kind of a muted reaction to the US China framework deal agreement that was announced last week. If stocks do move higher, do you think it'll be as a result of this type of news or positive economic news?
I think ultimately, Terry, it will go back to what it always is, which is the earnings news in the second and third quarter and the outlooks that come from them. Because ultimately, it's going to be how companies address it in terms of their profits and growth, and the ultimate picture of granularity that comes from those earnings that'll give the clarity that market wants. So I think it will ultimately be earnings and fundamentals on revenues that play out.
Published data, John, reveals that stocks have not been as expensive as they are now compared to bonds in almost 25 years. Is that a negative for stocks?
It absolutely is, Terry, particularly for U.S. stocks, which is why we've seen a big bid for non-U.S. stocks this year, particularly in developed country ones. Because, you're looking at a situation where if you are looking at cautious consumers, slower growth, slower profits, A 22 times forward earnings is pricing in a very aggressive view on earnings and revenue growth, and it probably needs to go down to a 17 or 18 PE with this current level of fundamentals.
So then what strategy should investors use now? Should they be looking at defense stocks, especially on the heels of this Middle East tension escalations?
I just think they need to be in large cap stocks outside the U.S. at a level of at least market weight, if not overweight, allocations in their portfolios. But I wouldn't go further than that because the U.S. is still a dominant player, and the tech stocks, which are a dominant part of the U.S. S&P 500 and Nasdaq, are something that really is not as available as widespread outside the United States as within it.
All right, stock wise, this month you chose 3 large cap stocks with a short term number 1 rank and very attractive long term Zacks VGM score of A. Sumitomo Corporation, Next PLC, and Sprouts Farmers Market.
Yeah, let's talk Sumitomo. This is a big, multifaceted business based in Japan, Tokyo, Japan. And they're in everything, Terry. But the thing you want to understand is they're having estimate revisions up 6% this year and 6% next year. This is largely because people are thinking, okay, there's going to be big 50% tariffs on China, mainland China, so this company will benefit. And so while it is a diversified operation, which typically gets overlooked, it does have a number 1 ranked score because those estimate revisions are so strong. The other one we've got here is Next, NXGPY. This is a British UK company that offers fashion and accessories for men, women, and children. So this is an amazingly profitable company. $467 in earnings this year, $504 in earnings next year. So you've got a 19 forward PE. This is probably for those of us who are U.S. Consumers and investors not aware of this stock. But anything that's making $5 a share in earnings that trades at $90 a share is certainly worth a look. And that's what I want to put on everyone's radar screens. The third one, Terry, is Sprouts Farmers Market, ticker SFM. And this is, again, another $5.08 a share this year for this company, $5.70 next year, with upside in estimate revisions of this year of 9% plus 9%, and next year 7.5%. So people are really, the organic food at home purchases are going up. And this company, you could have bought it a year and a half ago at $40 a share, Terry. Right now, we've got it at $160 a share. So you would have made 4 times your money on this company if you had read this turn right. And this is just something to pick up. This is just one of those chain grocery stores. I think they're based in Arizona that has a long ways to go to expand its footprint.
Our chief equity strategist and economist, John Blank, on stocks facing tariff headwinds. With John, I'm Terry Ruffalo.
This material is being provided for informational purposes only, and nothing herein constitutes investment, legal, accounting, or tax advice, or a recommendation to buy, sell, or hold a security. Do not act or rely upon the information and advice given in this podcast without seeking the services of competent and professional legal, tax, or accounting counsel. Publication and distribution of this podcast is not intended to create, and the information contained herein does not constitute an attorney-client relationship. No recommendation or advice is being given as to whether any investment or strategy is suitable for a particular investor. It should not be assumed that any investments in securities, companies, sectors, or markets identified and described were or will be profitable. All information is current as of the date herein and is subject to change without notice. Any views or opinions expressed may not reflect those of Zacks Investment Research as a whole.